The first thing I am testing, by far, the most important aspect, much more so than the greatest plan, the greatest technology, is tenacity. I have to see in the founder that he is or she is tenacious in their ability to persevere through challenges.
On the podcast today, I'm talking to Ken Friedman, who has an MBA from Harvard Business School and over 30 years of investing in businesses, whether they're startups or he co-founds them, and he shares his tips on how he evaluates companies. And if you're an entrepreneur or if you have a business, this is a good one to watch. Today, my guest is Ken Friedman. Ken has an MBA from Harvard Business School, and in 1986, he founded and became president of the investment banking broker-dealer of Houlihan Lokey. Houlihan Lokey became one of the largest private investment banks worldwide and has become a publicly traded company on the New York Stock Exchange with a market capitalization of approximately $8 billion. Subsequent to his Houlihan Lokey career, he founded the merchant banking firm of Friedman Enterprises. For the past 30 years, Friedman has focused on investing in numerous companies, of which he was either a co-founder or an early stage investor. Friedman is a frequent guest lecturer at USC Marshall School of Business to their MBA and undergrad programs, with an emphasis on entrepreneurship, investments, and finance. His personal passions include surfing, worldwide motorcycle adventures, architecture, nature, and health and wellness. Welcome, Ken.
Thank you very much, Jessica. I appreciate it.
Thank you. And I should start by saying how I met you is we serve together on the board that you chair of the UCLA Santa Monica Hospital. And we work together very extensively on integrative medicine because that's a passion that we both share.
Indeed it is. And I appreciate that.
Yes. And I have really enjoyed my time with you and learning, especially, I mean, you have so many interests, but today we're going to talk about business in general, in terms of entrepreneurs, what we can give them some tips and tricks and understanding of the funding process. Because my story is that I basically bootstrapped my company. Well, actually, as I say, I went to the best funder that I know, which is my mother, and I borrowed $2,000 from her. And that was how I started California Baby over 26 years ago. But I know today a lot of people want to go the funding route. And one thing I don't think that a lot of entrepreneurs really even understand is the difference between venture capital, private equity, investment bankers. Like, what do they all do? What are their goals? They all have goals, right? You've been in the, tell me a little bit about
Sure,
your
absolutely.
experience.
I've been in all three of those different kind of categories or segments of the finance world. And let me, as best I can, describe them for people because they are kind of conflated together frequently and people don't understand the nuances and distinctions. So I'll start with investment banking. So investment banking is what you traditionally think about when people talk about Wall Street. And what that means is investment bankers, and I had started the investment banking operation of Houlihan Lokey. In that context, you're agents, which means generally the product areas that you're going to be involved in include merger and acquisition advisory, which means to the extent, Jessica, you wanted to sell your company, you would hire an investment banker to represent you in the sale of that company. That investment banker would put together a comprehensive document articulating the different strategies, business lines, competition, your marketing.
Like a package. They would package us.
They would package you up, basically a more sophisticated real estate agent kind of engagement is a good way to think about it. And then that investment banker goes out and canvasses the universe of prospective buyers, and then ultimately negotiates on your behalf a transaction. The corollary in the merger and acquisition product line, we're only talking about one product line of investment banking, would be representing buyers. So to the extent that California Baby want to buy a competitive firm, likewise, you would retain an investment banker to perform that task. So that's a primary task of investment bankers. Secondly is raising capital. So if your company wants to raise capital, traditionally it's for growth. You would raise the
established company or a new company? Are we using California Baby as an example, or just any startup?
Generalize. So investment bankers generally stratify their markets. So some of the smaller investment banks will raise money for very early stage companies. The more predominant names like Goldman Sachs and Morgan Stanley and JP Morgan, they raise money for the Apple computers of the world, the more established companies. And then there's a middle tier, which is what I was pursuing at Land Loki, of sized companies that retain investment banks to raise capital as well. So each of those, by the way, each of those categories of company size demand a different kind of capital raise. Okay. So let's talk about I'll stay within the investment banking world, and then I'll talk about private equity and venture capital. So traditionally, the Wall Street firms are raising money two ways. They either raise it in the private markets, which means they're negotiating with institutional kind of investors, the Fidelities of the world, insurance companies, and funds that invest in more mature companies. That's the private realm. Then they do what's called public offerings, which is what catches everybody's attention. If California Baby, as an example, wanted to go public, you go public traditionally through what's called an initial public offering. Investment banks handle that entire process such that when the process is done of going public, you now have shares that the public can invest in. You're no longer a private company, and you can trade those shares. You can buy them and sell them either online or through your traditional stockbrokers. So that's kind of the second line of business, which is the raising capital, a corporate finance end of investment banking. The third component would be very sophisticated trading operations. And I won't get too deep into it, but suffice it to say, the markets are made or kept efficient by investment banking operations, the trading operations, the sales and trading operations that are constantly buying and selling stocks and bonds all day long. And they are the predominance of the market. And actually computerized trading now is the predominance of the market, where everything is algorithmically based. So I don't want to get too sophisticated, but suffice it to say there's a sales and trading operation. The last major component of, we're still in investment banking, which means you get paid as an agent. You're not taking an equity position in a company.
You're basically getting a commission at the end of the sale.
Commission, a percentage of the deal traditionally. So company sells for $1 billion, you may get $20 million as an example for a fee, an advisory fee, 2% of the deal.
Got it.
The fourth major component, and one I built specifically within my investment bank as well, was financial restructuring. Lots of companies, especially on the heels of the 80s, got into financial trouble because they were highly leveraged, which means they put a lot of debt on the company, much like you do in a house.
Right.
And they didn't have adequate cash flow to service the debt, and they went into Chapter 11. Chapter 11 process is a very lucrative end of the business for investment banks. They were either the creditors, the unsecured creditors, or the debtor itself, or the company itself. So those, and again, that has a distinct way of billing. That's a very high hourly rate of billing, plus a percentage of his assets are sold. So you have merger and acquisition advisory, raising capital, both private and public, sales and trading operations, and then financial restructuring. That's the investment banking world that you hear about. And its real purpose, they're not evil empires by any means like they're characterized. They enable businesses to grow.
Yep.
They are the mechanism by which capital is raised to feed our capitalistic system, which then leads to companies growing and hiring lots of people and wealth for people that are ultimately retiring in your retirement funds. Venture capital.
You're right.
Venture capital, which also has a series of stratification, generally is companies that are funds of capital that either are funds that people like me, high net worth people, have invested in. They're called blind pools of capital. It's like filling up this cup with money, and I don't know what it's going to be invested in. And then professional managers of that money go out and seek companies that want investment capital for growth. They're generally early stage companies to companies that aren't public yet. That's the venture capital kind of stratification.
High risk, high risk.
So what happens is, as pertains in all financial markets and otherwise, the earlier stage companies are the highest risk. The later stage, which is right before you go public and generally have significant sales and profitability, are lower risk. And that's why I said some funds like me, I only do very early stage companies. I want to invest at the highest end of the risk spectrum because that's where the greatest return potential exists. It's also where the most failures are, but hopefully you're more than compensated by the winners in your portfolio.
So it sounds like you really need to know how to evaluate. Can this become a company, right? Because it's an idea for the most part. So you have to have a lot of creative imagination, or you need to be able to evaluate the people or evaluate the company. And like, how do you do that? I mean, I don't want to get ahead of ourselves, but I think that's really fascinating.
Yeah, well, if you want to talk about that now, because that's a whole category in and of itself, we can.
Yeah, let's talk about that. Let's go there.
Okay.
You know, how is you as an investor, do you evaluate somebody who has an idea? And maybe, you know, just a plan, an outline. I think it's going to be this. Is that the kind of company you're investing in, or what do you want it to be?
Yeah. So what I want it to be generally is I'm either the founder, the co-founder, or the first round early stage investor, the seed capital or pre-seed, what's called pre-seed investor. And the reason I like that personally is that's the end of the spectrum that I find most stimulating in terms of the challenge associated with taking the seed of an idea and nurturing it, making it grow into something significant. And I like the nature of the people that are generally involved in starting enterprises as well. So what I've done for many years is I receive generally what are now PowerPoint presentations. They used to be very thick documents, 50, 60, 70 page business plans that delineated the idea for the business, the marketing plan, the sales strategy, the experiences of the people involved, and a financial set of projections. I cast most of that out initially. So I want to sit down face to face like we are today, and I start, it's an inquisition. It really is. I tend to be a very in-depth, intense inquirer into the minds of the founder, into the entrepreneur. The first thing I am testing, by far, the most important aspect, much more so than the greatest plan, the greatest technology, is tenacity. I have to see in the founder that he is or she is tenacious in their ability to persevere through challenges.
Now, how do you judge that? Because you've just met this person how, I mean, so I understand exactly what you're talking about, but it's hard to know because they're so enthusiastic, you know, yes, I'm going to do it. Yes. But then when the obstacles come, you know, it's a little different.
And that's part of it's not magic, and it's not intuitive, because I think intuition really is a flawed word as most people think of it. It's by virtue of interviewing thousands of people, reviewing thousands of business plans, investing in lots of companies and sitting side by side with those entrepreneurs through the early stages. And quite frankly, Jessica, it's being a real keen observer observer in life.
Right.
Really going beneath what I call the epidermal layer of every aspect of life, whether it's that hummingbird flying outside, whether it's the person you're speaking with, whether it's observing as you're riding or driving down the road, nature, and why is that tree a particular color, that flower a particular color. It's really being a keen observer of characteristics of human beings and nature. So if you've got that as a foundation, which I think is an essential foundation upon which to start answering your question, you then know the nature of the questions to ask people. And it could be as simple as posing certain scenarios. What would you do in this particular circumstance? It may be as simple as, tell me about your background. And if I hear somebody's had a background, I grew up in Beverly Hills, I went to the best schools, I never had to work, that's going to raise a red flag to me. I'm using that as an extreme, and not to say those people can't be extremely successful, because they can be, but I'd rather see someone that's come off the streets, been through hardship, maybe well educated, but has evidence that they have persevered through obstacles. So by virtue of the nature of the questions you ask, looking at their backgrounds, and then posing certain scenarios, you make a judgment call, right? You never know, but you make a judgment call. All I know is and you appreciate it, if you're an entrepreneur, if you're a founder of a company, you are going to run into challenges every single day.
Correct.
And the nature of the challenges are going to vary as the company grows. If you don't have an ebullient kind of demeanor, if you don't have this tenacity that I'm talking about, you're going to fail. Because
So would you say tenacity is number one on your list?
number one, when I do a lot
Above
of
education, above, advantages, going to the best schools, doing all that, just that doesn't count. What does that count for then? Why
all
are
those,
yeah.
right. All of those, there's a lot of elements. I'm only starting on one, right?
Yeah.
There's a lot of elements, what school you went to, the companies, your experience in the life that I can get to that matter. We haven't even talked about the business model yet, right? Or the product or service.
No, we haven't.
But yes, if you can't get through my threshold, I'll call it, condition of tenacity, the rest is academic. It really doesn't matter. It doesn't matter
If
because
it's a fantastic idea, even if all the metrics like point to yes, but that red flag comes up.
Yeah, the reason, and there's a reason why the typical person in my position or the typical venture capital firm, of which I participate in 4 different ones right now, they finance 1% of the companies they see. So you have 100 companies coming through and giving pitches or presenting their business concept. 1% of them make the funding round. So that gives you some ideas to the competition for capital. However, if I see someone that has a great business idea and they went to great schools, but they're not tenacious, I'm on to the next deal. There's too many other alternatives.
You wouldn't try to make it work. You wouldn't say, okay, look, I just need to fix this one part. Let me bring somebody in and shore that up.
No, because I don't generally want to start being that active. I don't want to roll up my sleeves and do that. If you are coming to me, you need to be well prepared. You could be in your very early stages, but you need to be well prepared with, especially the personnel and the like, because I'm not going to expend my time. I'm not some large fund. I've very consciously made an effort since I left Houlihan not to have personnel, people I have to manage. I want flexibility in my life. I invest my own capital. I didn't raise a fund. I have a very particular lifestyle that I crafted that's unique to my personal desires. So I don't have the desire nor the time to expend to start changing something as fundamental as the founder.
But well, yeah, as fundamental as the founder. And I know that the founder is so important. And I don't think that people, I know that they understand, and it's always because that founder is going to be driving the ship, right? They're going to be steering, and it's not just their vision. I don't think people understand that sometimes. I have a little bit of a thing when people think when they get funding, they've won the lottery, and like, that's it. Okay, I did it. I got the funding. Like, that was the job, right? And they don't understand that, no, the work is just going to begin. Actually, it's going to be a lot of hard work, because you have people now who have a lot of expectations, right? People who have money, who want to return on their money. That's really why I didn't take any money, because I didn't want to answer to anybody. So for me, I'd rather just go slower, because I don't want to tell how many shampoos we sold yesterday, and what is our plan for Q1 and Q2 and all of that stuff. And I need to exit this at a certain time. That is a lot of pressure for founders, and I don't think they realize that.
Absolutely. I think you're bringing up an excellent point. And I would not say you're traditional, having gotten to such a scale without raising external capital, but a few responses to what you said. I similarly relate to that, in that I made a conscious decision when I left Tulane. I was going to raise a very large fund, a private equity or venture capital fund. And I decided that I didn't want other masters as well, that I wanted to take my own capital and to invest it and kind of eat what I kill.
Right.
Meaning, if I have failures, I absorb them. If I have great successes, I'm the beneficiary. I work as hard as I want. And most entrepreneurs aren't real good at answering to other people. If we trace through my life, you will see a seed of irreverence towards authority, not illegally by any means, but I like to take my own risks. I like to plot my own plan, and I like to suffer or realize the benefits that are associated with that, all the consequences. When people like you're talking about that are viewing this start to contemplate raising capital, you absolutely are now subject to their particular whims and requirements.
Right.
And it's critical that you understand that from the outset. Like I characterized briefly, there's different types of capital that you can raise depending upon the stage you're in. Similarly, there are different types of investors. In the early stages, that is the traditional friends and family. Like you said, your mother.
Yeah.
That is the group you're going to go to for obvious reasons. They're the people that know you best. They may not be making a critical financial position. They're doing it because they love you or they want to see you succeed. They're a friend of yours and want to be part of what you're doing. They don't understand valuation and sophistication and securities. They just believe in you. I know Jessica, I know Ken, and I want to invest with them. And I'm not, putting the family fortune in. I'm putting enough in that it's comfortable. And if I lose that, that's fine as well.
Right.
Those people generally are not too intrusive. And if they are, you better be wary of, if you're going to have a friend or family that may be wary of that before you take their capital. Or if that's something you're willing to accept, just have the awareness of it. Some early stage founders, like we're talking about, they want advice. They do want to be associated with, I'll call it smart money, which means people that have some tangential interest or understanding of your company, the business, the service, or a functional area of business, and you value that. So you actually would like them to participate to some extent, and you can form an advisory board. It doesn't even have to be a board of directors. I've sat on many advisory boards when I may not want to sit on a board because of certain legal liability, where you can provide advice to these burgeoning opportunists and entrepreneurs to help them. So then I will contrast that to the traditional venture capital fund. So when you've gone through your friends and family and you're going into more sophisticated money, not to say high net worth can't be sophisticated, because believe me, they are. They can be very sophisticated.
Absolutely.
The venture capital fund now, who are beholden to their limited partners that invested in the fund, are going to be more demanding. They are going to be more active. They will, and that's a role you may want them to play. They are going to help with recruitment of key management personnel. They are going to review your financial statements on a regular basis. They are going to make a lot of recommendations to you. They're owners in the business with you.
Sounds like a job.
It's a job. Absolutely. Well,
Sounds like the founder has
yeah.
now has a position and is now taken a job and just a cog in the wheel in this bigger kind of master
And
plan.
hopefully a positive cog in the wheel, right?
But yes, but I don't know that they know that, right? I don't
You mean the entrepreneur may not know that?
I don't feel like the entrepreneur understands that part, even both of them. Like even what just my experience has been, because I've mentored, some typically women who started businesses, and they do get friends and family, money, and it's taken them to a certain level, and they've kind of maxed out there, and now they need to go and actually get some more serious money. So they're kind of in a no man's land in a way. They need to make the jump. What I have seen is that they actually get very confused when they're going out to get funding. Let's call it round one of funding, because everybody has a different point of view.
Call it Series A
or Series A, right?
Mhm.
Initial funding. So, but everybody has a different idea, on how to run the business, how to grow the business. So they end up being very confused, and really not understanding what's going on now, what they've gotten themselves into. What advice would you give to an entrepreneur at that stage? They've got a good product, they've grown it, they've shown market viability, but they need more money, and now they're just kind of confused.
Right. So there's a few different options and avenues. If you're the unsophisticated, inexperienced entrepreneur,
Yeah, first timer, let's say.
first timer, which is quite frankly the predominance of the people that go out to raise money. They're not experienced in raising capital and building companies. If we just look at a pyramid, right, at the bottom of the pyramid is the person that's never built a business before. At the top would be what's called the serial entrepreneur that's been through it many. If you're more at the base, which is what we're talking about, the one that's more naive only by virtue of inexperience.
Correct.
You have a few options. Option one is there are some investment banks at the smaller end of the spectrum that will help you raise the capital, especially if they think there's great potential for additional rounds of money raising.
And what does the entrepreneur have to give up? Let's say at that level, if it's 100% and they've given up maybe 5% for friends and families, and now they go out to raise, what are they going to have to give up?
So that's a highly variable number. I mean, and the markets, let me tell you, they have changed. And we could talk about how they've changed. But first thing, you're going to have an agency fee to the investment banker, and they may take we're talking about a small raise. It might be a couple $1 million.
Yeah. Which is not a lot of money. It sounds like a lot of money, but it goes fast.
And that's why there's very few investment bankers that are credible in that end of the market, but they'll take 5 to 10% in a fee, a cash fee, and then they'll take some warrants that entitle them to some ownership in the company that's related to how much you give up. The amount you give up for that 2 to 3 million depends upon the value of the company then. So if the value of your company post money, what's called post money, is 10 million, you're giving up 20 to 30% of the company. If it's larger, you give up less. If it's smaller, you give up more.
I think most people understand this by seeing maybe Shark Tank on TV. And what they're arguing about is the value of the company.
Absolutely.
The entrepreneur thinks it's worth way more. And, that's kind of an interesting thing. Like, how do you value?
Right. You do want that entrepreneur to thinking it's more, but he's got to be realistic, right? But the nature of the entrepreneurs, they think greatly about their company's prospects and their ability to execute. So, but it's a highly variable range. I'd say if I was to generalize, I'd say generally you're going to give up in that round 20%, 25%.
And that's just your first. How many typically do companies have? You're going to go through that $2 million pretty quick.
Yeah, not talking about these companies, many of which I'm investing in now, these high-tech companies that have zero revenues.
Oh, yeah.
They invest their first round, they get a couple $1 million, and they have extraordinary valuations. Those, which is the representation of the tech end of the business and what's happening today. because companies are becoming worth $1 billion
Yeah.
at such speeds like we've never seen historically. I'm talking about more the mom and pop.
Yeah. Like,
traditional
let's say
business.
somebody like who's come out with like a spirit drink or, you know,
A new direct to consumer kind of
direct to
product.
consumer
Well,
type of product. Yeah. Because
right.
high tech, who the heck knows what's going on
Let me
there?
tell
I
you,
don't.
yeah, it's a different world, and valuations are extraordinary, to put it mildly, right
But
now.
you know what's unfair is that I think entrepreneurs are being held to that standard. They're being held, like if you have a direct to consumer business, they are thinking in valuations of high tech because this is what we hear and this is what we read about. And it causes a lot of confusion there.
The market will make you very sober then.
Right.
When you start to go out and you
Right.
can go to so you have investment bankers that could represent you. You can go to the financing sources directly, which is what a lot of people do. You can go online today, and the degree to which you can source venture capitalists that invest in particular kind of products at this scale, at this stage of the company, you can get an extensive list. You then put together your own PowerPoint presentation that might be about 15 slides, 18 slides, with kind of a seminal kind of a framework that's traditional. And you basically are cold calling, and you're sending out to a lot of people, the community, and trying to stand out in some way from everyone else doing the same thing. And you may get a couple % response rate that then enables you to have a deeper conversation with those groups. You can go to lawyers. I hardly ever advocate the use of lawyers until such a time as you need to document something, but most people aren't sophisticated. The only danger with going to lawyers, no disrespect to lawyers, because God knows I've dealt with an enormous number, is sometimes they cross the threshold of thinking they're business people. They're not.
Exactly. I know.
They're
I know
not.
exactly what you're talking about.
Yeah, they need to be in their proper role. But the only reason I bring it up is they may be the ones that help you document the private placement memorandum, and they typically have relationships with financing sources.
Okay.
So I'm not advocating they're negotiating the deal from a business perspective, but they may be the person that helps you document something, and then may have a list of people they deal with that may be potential investors. So they're an alternative route. The people that invested, those friends and family, sometimes they have relationships as well. It becomes, if you're new to the game, if you've never done it before, it's somewhat of a shotgun approach you need to take. You can't just fire a shot and say, I'm going to this particular VC and I know they're going to raise the money. That's a rarity. So you need to pursue relationships with people through other relationships that you have, the attorneys, the friends and family, smart people that you might know, or networked people, or the sophisticated investment banker that already has the relationships. Lastly, and what's been growing is the internet. There are now options, a number of them, that are sites in essence that enable the entrepreneur to go out directly to investors via the internet through a particular process, and it's a legal process, but it's pretty straightforward.
It's not like a GoFundMe type of thing. It's actually like a real kind of.
It's for raising capital. GoFund is for a particular purpose. This is companies like we're talking about want to raise money.
Is there a name? Do you know a name of, like, if somebody?
I don't want to invest. I don't want to represent any particular one, but you can go online.
They can just search.
I've never used them personally, so I don't want to vouch for their credibility.
Got it.
It's not the route I've gone, but I think it's definitely merits consideration by your audience members that are at this stage.
A bunch of strangers, basically, right? You're just kind of going up to the internet.
They're strangers, and they won't be part of your business per se. They're going to be very limited kind of investors.
That would scare me, because I feel I would be thinking confidentiality. Who are these people? Because it does matter who you do business with. That is very important to me. If I don't like the other person, if I don't trust the other person, I don't care if I'm buying bottles, I don't care if I'm buying labels, I won't do business with them, because it does matter who you do business with. Do you have that same feeling?
Oh, my ethical standards extreme. I walk away from the first sign that somebody is not of a high moral caliber, it goes into a box I have in life. It's called life is too short. And it does,
Yes,
because the saying, if you sleep with dogs, you get fleas.
yes. And
And what
it's
that
so
means
true.
is if you're with people that show a side that's not reputable, walk away, because you will never
Doesn't
get your
get better.
you have one reputation in life,
Yes.
and you don't want to scar it or mar it, because to try to get it back, and I have these conversations with my kids, never sacrifice your integrity in
Yeah.
your deal.
I think
Because
that's
you've got
number
a lot of
one.
lining to do, and people are never gonna trust you again. And let me tell you, Jessica, on this point, because I have a lot of conversations on this, it's a big issue for me in all aspects of my life, kind of a high moral fiber. Had it this morning with the shoot, in fact, but it's critical. It's really critical. It's a foundation of, I think, day-to-day existence in your personal life, as well as that of your business life.
I feel like, and I hear you because I believe I think it makes life easier. It, you know, but I feel like some people feel like, well, it's business and it's about making money. And if they can give me the money and yeah, and you know, what would you say to people like that? I mean, I know
Well,
what you would say, but what would you
yeah.
say?
Well, I would say be cautious, right? Tread lightly in those realms and be smart about it. Ultimately, I don't like to tell people what to do per se. I like to raise a lot of questions. So I would ask those people to really do some soul searching when they find themselves with that mentality. Because, by the way, if the entrepreneur is saying it's all about the money and I'm willing to make these kind of sacrifices,
Well, they're
I'm not,
hearing these huge numbers, right? They're hearing that
I
somebody's a
get it.
billionaire and that's a billionaire. So they're thinking about money. And I never think about money. It's money will always follow. But these people are thinking about money and they're thinking it's business. I'm here to make money. I want to make a lot of money. You know,
Yeah, and I don't fault people for that. I think there are other elements that are as important that's going to ultimately result in you making a lot of money. And if there's a sacrifice like we're talking about in the ethical fiber or the morality of the individual entrepreneur that's looking at somebody that they don't feel so good about inviting to their own house, or they won't want to be a friend with, be wary is what I would say,
mhm,
because it ultimately can come back to bite you and harm your financial aspirations as well, and your reputation.
right.
And I will tell you, financial sources are going to pay attention to that too. Traditionally, like we started to allude to,
Yeah.
you have a series of financings, and that we talked about Series A. Well, Series B wants to know, who's Series A?
Yeah.
Tell me about them, because now
Yeah.
they're getting in bed, so to speak,
Right.
with that investor group as well. And they have a reputation and they have investors. So it then would just carry on through the duration of your cycle of being in business.
Right.
So
Right.
we,
I think that that is, and that's what you said, number one, red flag. And I think that people and entrepreneurs really need to understand that is, even though investors are investing money, they're not just handing out money. They want a return on their investment, and they're very careful on, you know, just making sure that they're going to get that return. It's not just throwing it into the wind and seeing if it flies back.
yeah, and
Um,
that's by the way, in response to what you just said, that is the contrast that might exist between the entrepreneur and raising the money. So the entrepreneur, yes, wants to make money, or they can't retain themselves in a business, but they have other manifestations of being in business, such as passion and doing good for other people and the like, that start to enter into the equation of why they start a company. The professional investors, they want to make money. They have to.
that's their
That's how they
job. That's what they do.
That's all. They're getting paid by people that invest in them to generate a return on capital. They're not being paid to, address climate change. They're not being addressed to be good citizens.
Right.
They're being paid to make money. Do it ethically, but being paid to make money. So
Right.
you have to make sure there's an alignment
Right.
between the people you're dealing with, who are going to be on your board. We're talking about the venture capital community, and will have a mandatory requirement to sell the company or take it public. They have to.
They
They
have to.
want their time horizons might be 3 to 7 years for what's
Right.
called a liquidity event, which
Right.
means within that time period, they've got to return capital to their investors, which requires them to either go public or sell the company.
Right.
Someone like you who's been in business for many years has no interest in that. That makes it harder to accept capital too. You can go to banks and get debt financing, which is a whole nother subject, but you would not be able to get traditional venture capital investors in unless you had a mechanism to buy them out in 3 to 7 years.
Yeah, I did go through that. I actually took about 5 years. It took me about 5 years to really fully understand all of the players, and of course, at a certain point, and it's usually around year 10, is when all of the private equity guys and gals come out. And that's probably sounds like the sweet spot when they buy the company so they can grow it and then they'll eventually sell it or take it public, whatever they'll do. And, the sell job, I call it a sell job, was I want to help you grow your company. And I think that's where a lot of people get, confused, because really the job of a private equity is to sell your company, right? Yes, they're going to.
We haven't talked about private equity yet, have we?
We haven't
That's,
even.
yeah,
No,
which is the mature end of the business.
that's well, when you say mature, what does mature look like? Because I saw it
Okay.
at about year 10.
So we started with investment bank, when
Right.
we talked about the nature of that
Yeah.
position. Then we talked about venture capital, which is
Right.
typically financing rounds that precede going public.
Yeah.
Venture capitalists don't traditionally invest in companies that have already gone public because
Right.
the rate of return they can generate is generally smaller by that point in time. They want to be at the higher risk end of the spectrum.
Right.
Then there's the private equity firms, and those are the companies that are looking to buy more mature, more established companies for a couple different reasons. What they had done traditionally, like in the 80s and 90s, is they did something called leverage buyouts. So they would use the assets and cash flow of the companies to put a lot of debt on the company. They
Right.
put up 10, 20% in cash, and then they would have the cash flow of the company service the debt and then ultimately sell that company or take it public. And in that context, they were usually cutting costs. They might have to cut head count, do smart things regarding sourcing and the like. They did things to enhance the cash flow generation of the company because they had a high level of debt to service.
And then the poor founder doesn't understand that, or the poor, mom and pop or small business owner really doesn't understand all of that. I mean, that's very sophisticated what you just said.
Except having said that, this is the more mature end of the business. This is the larger end of the business in terms of established companies.
Right.
And the founders either are bought out completely,
Yeah.
so they're gone and they've been cashed out. They may have a residual interest, or they may stay on for a year or two, or have what's called an earnout, where they participate in the earnings for the next couple of years. So it kind of spans the spectrum from here's your check, thank you, we'll take
Right.
it from here, to we'll leave you a little bit of equity, we'll buy 80% of the company as an example, and you have 20, and you can still be CEO for a year or two, to you walk away and it doesn't matter what they do with it. They also, private equity companies do that, and then they take them public also. They kind of clean up, what I'm calling clean them up.
Yeah.
Or Jessica, they do play a valuable role in the marketplace.
I agree.
Or they start doing what's called rolling up companies. So they'll buy a company that's established in the furniture field and it's a large player. Then they'll start to go out and buy a number of competitive firms that are generally smaller to make the overall company much bigger. And then either sell it to one company, a strategic buyer, or they take it public. So the private equity world is a different world. It's not generally, I'm generalizing because what's has started to happen is they're overlapping these different realms right now, where VCs have gotten into some of the private equity world and private equity firms have gotten into the venture capital world, as they're both looking at the returns available on each side.
Okay.
But that's generally what will happen. Private equity firms buy public companies and take them private, or they buy companies like yours that are already private.
Yeah.
And then clean them up beyond that, which they already have, because they have portfolios of companies. These private equity firms can be 10, 20, $30 billion funds.
Yeah.
These are big funds.
Right.
And they think about leveraging it up, they're buying 50, 60, 70 billion dollars of companies. Some of
And they
these deals,
lose their funding, don't they? If they don't spend it, if they're not buying, then there's a pullback period.
yeah, it's pretty rare that
Oh,
the money's been raised and they return it.
okay.
I mean, generally these, you'll see 10 to 12-year provisions
Okay.
in the agreements, if you will, the limited partnership agreements for these funds.
Okay.
It's rare that somebody returns capital. Has it happened? Yes.
Okay.
Not generally, though. They generally don't have a problem putting the money out within that time frame,
Okay.
and they do.
Okay.
And there is an extraordinary amount of both venture capital and private equity and public offering money available as
Right.
well. There's a whole nother realm I'll talk briefly about because people are reading about it all the time now. SPACs.
Oh, I know. That is,
And that's
everybody has a SPAC. Every celebrity has a SPAC. Everybody seems to have a SPAC.
the smart financial guys have SPACs. And what's happening, you even saw Donald Trump Media is going public now through a SPAC process. But what's happened is these are public shells that have cash sitting in them. And then they do have a time frame, usually a couple of years, over which they have to invest in companies. And they are now making acquisitions and then raising money at the same time of private companies. And then they raise capital into it. And that company is suddenly a public company. It's
Right.
kind of what in the investment banking parlance, it's a backdoor method.
Right.
Be very expeditious to go public. And the valuations we're seeing in SPACs is quite extraordinary.
Well, isn't the bar lower also to go public in a SPAC? Because it's like that is the SPAC is going public versus the company, and there's less scrutiny.
There is less regulatory scrutiny on the company going public. It's an easier process than going public. It's a less scrutinized process than going public. And that's why it facilitates a lot of companies, like you say, that otherwise might not be prime candidates.
Right.
To go, it's like a reverse merger into the SPAC. But that is a vehicle that if you're the people watching this reached a certain scale has become a viable option in the market today.
Okay, so let's switch gears a little bit now. I want to talk about women in business, and that's a passion of mine, supporting women in business, because I feel like it's new for us. You know, we're I feel like women are very good at doing business. I feel like we have very good instincts. Obviously we can multitask, we take long-term view of things. But we haven't been as socialized in business the way men have. This is just my personal opinion. And you can tell me if you agree with that. But I mean, even just from the fact that, football, even playing football has like business aspects to it, right? Just the planning and the organization and the working together and all of that. And we usually, women don't play football. So we're just not socialized that way. We've been socialized to be good girls. We've been socialized to, be polite and, unless, there's always exceptions, but I'm talking about in general. My suggestion to most women is to never wait to be approached, always be proactive, always be the one out there, introducing yourself. If you're at a conference, if you're in in a meeting, like men will raise their hand and say something when they really don't even have a point sometimes. And women will hold back and they'll evaluate it. And they want their point to be perfectly crafted. And sometimes they get overlooked for that reason, in my opinion. You've been in the big business world. What are your thoughts or just tips and suggestions for women?
Yeah, I think if we look at the rationale behind what you just said and the basis for it, it's understandable, right? If we look into the 50s and 60s, women, and I'm going to generalize, they were housewives. They played a traditional role and a very important role raising the kids and being at home.
Yeah.
And once they reached a certain age, they may go out and become gainfully employed. And the task generally, because that was the culture of the times,
Yeah.
was a more menial kind of position. You weren't ascending
You
to
were a secretary, or you were, you know,
or nurses or stewardesses
Mhm.
and the like. You weren't ascending to the chief executive officer role because by virtue of just not being there for the prior 20 years, the data's not there for you to have risen there. So I think then what happened, and because I've talked to lots of women about this and thought about it, then you had the women's liberation movement, really important movement to kind of precipitate and emancipate women as equals to men in a variety of different contexts. And that one of those contexts started to be nipping at the business world in the very nascent stages of, hey, look at us. We can be more than, a secretary or a nurse or stewardess, not to disparage those by any means, all very important roles in every organization.
Correct.
And so I think it started to emancipate the culture to being more receptive to women in the workplace. And these things take decades, cultural changes.
Correct.
In history across a breadth of different issues. Then you had, I think, maybe cause and effect, divorces started to become culturally acceptable.
Right.
And all of a sudden, and now it's more than half of marriages,
right.
Women have to earn money.
Right.
They maybe did not come out of a situation where the man could support them for the rest of their lives. So now they were confronted in their 20s, 30s, 40s, even 50s with, I got to figure out a way to make money.
Right.
So now more women, not out of choice maybe, were compelled to go into business. So all of these elements started to form a demand by women to be in business. And then there were certain cultural changes that started to aid in the receptivity of women. Okay. They weren't in the boardroom yet. They weren't in the C-suites yet. They were starting some businesses, but it takes time to ascend. If we look today, it's pretty impressive what's happened in terms of just factual data of what's happened with women ascending in business. And like I said, it takes decades for the number. You're never going to be equal in 30, 40, 50 years
Right.
in representation. But I looked at some data, even at Fortune 500 companies today, there's 41 or 42 women CEOs. Every year over the past 5 years, it's ascending quite a bit. And I would expect that number to continue to ascend for some of the reasons that I just talked about. Additionally, the percentage of entrepreneurs that are women is burgeoning very rapidly.
Which is where I think is where women should go. Start your own business.
Well, I think regardless of gender, I think it's personally speaking the best opportunity for people, especially today for a number of reasons. But I think what's happening is capital sources that we were talking about have now become more receptive to financing women because they're seeing women in business be very successful. Look at major motor companies, auto companies being run by women. I can list a number of, look at UCLA run by a woman.
Yes.
Here we have a multi-billion-dollar enterprise. Our CEO, Johnny's, is a woman, a very capable CEO of a significant institution. So I think the marketplace, the receptivity, the culture now is as receptive as it's ever been. So now how do you play to improve your chances? I think the first thing, Jessica, is, and I would advocate this to every individual, be they male or female, you have to kind of manifest what it is you are naturally.
Right.
As soon as you are too cognizant of trying to guess what personality traits you might take on to be more receptive or to be accepted in a certain context, you're going to have an internal stress there. And you're never going to completely win the game of what's going to work, because I think there's a multitude, just like for men, there's a multitude of personality types and traits that can succeed for women. And I
Does that fall under love what you do kind of thing?
And be who you are.
And be who you are.
Right.
More than, would you say, if you had to give it the advice between the two, love what you do or be who you are, you would
be who you are. I would be who you are first. Absolutely. Yeah. I think that's seminal to a happy existence.
Yeah.
Is just if you expend the time and it takes it to go inside and really understand what it is and who you are as a human being. And I don't want to use the platitude of purpose, but it starts getting to your internal wiring.
It takes a lot of soul searching, though. Isn't it much easier just to go to business school and say, I want to be in business, or I want to be a lawyer, I want to be this, and then you mold yourself to that versus like soul search and go, this is really who I am.
And so how, as a result of that, why do we have so much stress and dysfunction in society? Right. It's like the Instagram social media world of trying to guess what it takes for people to like you.
Yeah, the algorithm, guessing the algorithm.
Right. And you never win that game. It's really easy, just like we were talking about earlier with ethics and morality. Well, you're just honest all the time. You don't have to keep track of what you said. It's also best to live a life without fear and manifesting that which you are naturally. Same thing with women in business then. And that is, you arrived with a certain personality. You can affect that and certain traits within a certain band. There's kind of a gray area around each of our personality traits. As an example, women generally are more passive for lots of reasons than men are. I get that. We're more, aggressive naturally for a lot of reasons that go back to Neanderthal days for that matter.
Or even just biologically.
That you're characterized as passive, you may have to step that up a little bit, right? It's not as though I'm advocating become aggressive and ultra assertive, but just modify that a little bit. Like you say, if you're sitting at a table in a conference, start the introduction yourself. Something as simple as that.
Right.
Is still being true to who you are, but recognizing and being cognizant of what it takes to succeed as well. I think you have to have internal ambitions also that are realistic. I think men, by virtue of our culture and history, have expectations of rising, many of whom think they should be, CEO expeditiously.
They have that expectation, like they're going to do it. And women kind of, they realize that they have to work there. Oh, I'm not sure. How do I get there? Men just go, oh, I'm going to go there.
Right. Well, it's changing expectations, right? And I think as I talked about these different cultural changes that have taken place, it's becoming more and more realistic to have an ambition that's greater than it otherwise would have been 5 years ago, 10 years ago, 15, 20 years ago. This confluence of cultural change and capital being available and demonstrably women being in very significant positions in this country makes it more likely that those ambitions can be realized. So I think it's important to elevate your ambitions as well as part of this concept. I think engendering respect is critical. I think it's probably easier for a presumption of respect of a man than a woman is my guess. And there's anecdotal evidence to show that's the case, right? But I think as a woman, make sure all conduct is one, when you're thinking about it, that engenders the respect of other women and men. I think that's a really important attribute.
That's a really good point, because I think sometimes as women, we feel, and I'm just speaking from my point of view, is that I have to deal with men. I have to make the impression on the man. I think sometimes we forget about women. We have to make the impression on women, and we have to have kind of that sisterhood, and build that coalition.
Biggest challenge. Women may be your biggest challenge, right?
You mean me personally, or just in general?
General. In the context of a business atmosphere.
Women are more critical. I think women are much more critical. I think sometimes men will go, they'll be just more accepting. They take you at face value. I think women will be, kind of breaking it down. I've worked with women, and I have a female team at my manufacturing facility, and boy, can they get the job done. They can get the job done. But what is critical is they have to get along. I have also, not at work, but outside of work, I've dealt with women who didn't get along, and they're just never going to get along. And that was a nightmare. But when women get along, they come together and they can work like the best team that you've ever seen. Absolutely. And get a lot done.
I think it's incontrovertible that women possess skills that are equivalent to men in business. Maybe we could generalize about certain kinds of industries and the like, where just the data show men tend to gravitate more towards them. But that has nothing to do with capabilities, nothing whatsoever.
Nothing.
And I think the world is recognizing that. We could quarrel about, well, do they get equal pay? Well, are they treated the same in a boardroom? It's happening. Is it there yet? No. But is the trend line positive? Absolutely. Absolutely it is. So I would never underestimate the prospects for women today and going forward in business. And like I said a little earlier, all the data is ascending in terms of the anecdotal data demonstrating women's success in business, whether it be at the nascent stages of founding companies, to getting financing, to becoming CEOs, to being in the boardrooms of major companies. So
what is your big tip?
What's
Sorry.
that? I was just going to say, as women who may be a bit skeptical of that, look at the data, look at the reality. And
Yeah,
yes,
some women would go, yeah, sure, but not really. Not when I've pitched. When I've pitched, and I didn't get funding, and this other guy pitched, and his product isn't as good as mine, and blah 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 blah, and he got funding.
And that gap is getting smaller. It's my point. Is
Yeah.
there still a gap? Of course there is.
Sure.
We can see that. Are there reasons for the gap? Yes, because it takes so much time to go from here to here. Is it happening? Absolutely. Is there room for improvement in certain areas? Of course, absolutely.
So
But
what would you?
If one chooses to have a positive attitude about it and look at the facts, it's empowering. If one chooses to focus on the gap and the negativity, as opposed to the gap as an opportunity to close it, that's a choice we each make.
Yeah, that's a great point. That's a great point. And that's really the fundamental characteristic of an entrepreneur, right? They really don't see the negative. They're always just seeing the positive.
It kind of comes full circle to that tenacity and optimism. No doubt about it.
So if you were going to give advice, your big tip advice for women in business, and then just entrepreneurs in general, what would it be? Or have you thought about that?
I would say bring to entrepreneurism a good sense of who you are as an individual, what motivates you to, I have a test. I give it to my kids and I do it for myself every day. What's motivating you to get up in the morning every day? Are you engaged in activities, be they business and otherwise, that are putting a smile on your face, motivating you to get out of bed, and not wanting to go to sleep at night only because you have to recharge, but because you're so excited about what you're doing day to day? That's the ultimate entrepreneur test, and that's the ultimate test for any human being, right? Whether you're in a job, whether you're starting a company, or whether you're just dealing with life's challenges. So try to attain that stage before you then decide, well, what is it in business where I can actually pay the bills or build value that I'm passionate about? Because that's synchronized with what I just said. That what you're passionate about is going to get you out of bed every day and put a smile on your face. And an entrepreneur, as you know, has to work 12, 14, 16 hours a day, day in and day out. So you don't want that to be perceived as drudgery. And then third, I would say, make a difference in the world. This is another saying I have is life is short and death is long. A lot of people do what I call tread water in life. And then what? Then they retired and they die. They made no contribution to making the world a little bit better place. Be consequential. You've heard me say that about my chairmanship at UCLA. I want my chairmanship to be consequential. I just don't want to run, a series of board meetings. I want to make a difference in people's health and wellness. Likewise, and I know you want to make a difference in people's lives with your products and the love and care that goes into your products and the nature of the ingredients and the like. Do that in your business as well. They're not mutually exclusive concepts, making money and making the world a little bit better. Mm-hmm. So that would be my advice as well.
Right. Well, you certainly inspire me. It's been a wonderful thing that I met you, and I feel honored that I am just able to talk to you and observe you. And I feel honored that you take the time to talk to me. And
Thank you.
I have thrown ideas by you, and I've come to you for advice, and you've always given me fantastic advice. And it's been along what you've said. It's very consistent. You're very consistent, and I appreciate that.
Thank you. It's been an honor and a privilege to participate in this with you as well.
Thank you. Okay, well, with that, I think we'll end. And so wonderful, again, speaking to you. And we'll hopefully have many more conversations.